and just say again, good afternoon, and thank you so much for joining me to give me a little bit of time to talk about some of the recent market volatility that we've seen, how it's impacting our 401k plans, and what can we do about it, and how does this compare to what we've seen historically in the markets. I think this is a great time to be having this conversation for a number of reasons. First, it's open enrollment. Now, your 401k plan is not directly related to open enrollment, but it's a time period, a 2 or 3 week period where we're thinking about all the benefits that our employer offers us. We're being reminded of all the great benefits, and we're trying to figure out what's best for us and our families. And while the 401k plan does not necessarily fall into open enrollment, really because you don't have to make elections during that time, I think it should still be considered because, again, it's a benefit that your company offers you, and it has a direct impact on your family and your financial stability. The second reason is because it's December 1st, we're heading into the beginning of the year. And oftentimes we tell ourselves at the very least that we're going to make some New Year's resolutions. And oftentimes those end up being financial resolutions. And selfishly, I like to think that the 401k plan might be a part of that. So I just think it's a great opportunity to have this conversation prior to the beginning of the year and us trying to think about how we'll map out the next 12 months. And the last reason, again, I alluded to it, that this is a great time to be having this conversation is because what we've seen in our 401k accounts throughout 2022. Now, I will say we've had actually a great couple of months at this point. The past 2 months, the markets have been up for the first time. We've had consecutive months with the market having a positive increase since last year, since 2021. However, essentially January 1st, give or take a day until September 30th, all the way through the first 3 quarters of the year, we saw a lot of volatility and a lot of regression back to previous levels of the market. So we're going to talk about all that again in a historical context, what it means. I'll just encourage anybody who has any questions, just go right ahead and ask them. I kind of know how I can be. I can just get on a roll and just keep talking. If you do have those questions, if you see me glance to my right, I'm looking at the chat box, which I actually think I need to enable. I'll do that right now. And the Q&A feature. You can ask me questions one of those either way. You'll also see our contact information a couple of different times along the way. We're always available. It's not just when we have dedicated days of one-on-one meetings or a presentation like this. We are available Monday through Friday, 9 to 5, to ask financial questions. I mean, it could be about your 401k plan, but the reality is it can be about anything that's financially driven. The way I like to put it is there's no question too small. They're complimentary and confidential conversations. And we're a pretty effective first line of defense for questions that you have, because if it's outside the scope of something that we can help with, we'll certainly let you know, but we'll probably point you in the right direction for where to get that answer. So I think then, this presentation will be the next 35 or 40 minutes or so. But again, it can be as conversational as we can with any questions that you might have. So getting into it, if you haven't heard of us before, One Digital is the retirement plan advisor for the Academy. You might have heard of us under a different name. We used to be Hightower, just a different name, same team. I've been working with the Academy for years now. And as the advisor, we are the ones who give advice. And that happens on a company or a leadership level as well as an employee level. Just kind of highlighted some of those questions that you can ask us. But again, it can be about the 401k plan, but it can be about budgeting, getting out of debt towards the end of your career. It could be Social Security, Medicare, creating an income stream, and everything in between. Saving for a big purchase or a children's college, right? Think of us as your resource for those questions. We're also part of the group that selects and monitors all the investments that are available to you in your 401k plan. So being part of that group, we are very intimate, or we have a very intimate understanding of what's available to you. And positions us well to be having this conversation about volatility. So my name is Keith Huber. I'm a certified financial planner and an investment advisor with the team. If you have any questions for me directly, you can reach me by email at keith.huber@onedigital.com. Now, the last thing I'll say by way of introduction is we are completely separate and independent from T. Rowe Price. In our world, we call them the record keeper, but just think of them as the administrator of your 401k plan. They handle all of the administrative aspects. So you log into your account for them, you make changes, things of that nature. The best way to differentiate the two companies that are working with you, because we are two completely separate and independent companies, but we work towards the same goal of providing a best-in-class retirement benefit. But if I have questions about what to do, I can reach out to One Digital. If I have questions about how to do it, I'd reach out to T. Rowe. Great example is if I don't know if I should go from 5 to 6% or pre-tax to Roth or investment X to investment Y. And I'm just not sure if I'm invested appropriately altogether. Great opportunity to reach out to one of the certified financial planners on our team. And you can see the contact information in the bottom left of the screen. If I already know I want to go from 5 to 6% or pre-tax to Roth or investment X to investment Y, I'm just having trouble doing it. Great opportunity to give T. Rowe a call because they can actually make those changes for you over the phone. But of course, if you prefer to do things online, all of those capabilities are available at T. Rowe Price's website as well. So 4 main things we're going to talk about today. First, setting the stage about investing in volatile markets, contributing to the retirement plan. Just a reminder why it's really important to be doing that now, as long as other things are still going right, but we'll get into that. And a little bit about investing in the retirement plan specifically, what's available to me. And then finally, I like to bookend my presentations with just a reminder about beneficiaries. So many people don't have them, but they're so very important, right? Beneficiaries, who I choose to receive my money if I were to pass away prematurely or pass away in general, it would go to my beneficiary. So if you are married, you legally have to put your spouse, but if you're not married, you can put whomever you'd like. And let this serve as a reminder that all of your accounts, be it 401k or IRAs or investments or bank accounts, make sure your beneficiaries are there and updated, as well as insurance policies, life insurance policies. Got to make sure that they're updated and that you even have one. A lot of times what happens is somebody starts at a company and through their open enrollment period, right, when they're electing all their benefits, they're adding beneficiaries along the way to some company sponsored benefits. But the 401k plan, they think they checked that box, but they didn't. Because the only way that you can add your beneficiary is going to T. Rowe Price's website. So if you haven't done that, then you don't have one. And it's very important to take the 5 minutes or so and just put in a primary and ideally a contingent or secondary. All right. So let's talk a little bit about investing in volatile markets. I said it in my introduction, but it's no secret that 2020 has been a historically poor year for the markets, right? From essentially January 1st, again, give or take a day, the market's not open on New Year's Day, January 2nd, up through the end of the third quarter, we have seen a precipitous drop in our accounts. And I will just level with everybody. The vast majority, there's always an exception to the rule, but almost everybody in the country has lost money in 2022. And I really, want to make that point clear because it's, a lot of people want to think that it's just because they're not in the right spot in the market or, their portfolio is not diversified. The reality is you were invested in commodities or you just had your money in the bank or you lost money. That's just been the case for the first 3 quarters of 2022. Now, that sounds pretty doom and gloom, right? Everybody has lost money in 2022. The reality is, if we zoom out and look at what's happened in 2022 in a much larger, wider context, it all of a sudden doesn't seem so bad. So there's a lot of, and as advisors, we can kind of cherry pick statistics to prove any point that we want to make. And I try my best not to do that. There's a lot of statistics that support that. But what I think and what I like to share that paints that picture most clearly. And the picture that I'm looking to paint is that this historically poor year for the markets is coming at the tail end of what has really been a 12-year-long bull run. 12 years of the markets essentially just taking up and up and up and up. Now, there's been speed bumps, but the reality is they have just been speed bumps. Now, some of them have seemed more dramatic than others. Of course, look at 2 years ago and at the onset of COVID. Right, from January 1st to March 23rd, the S&P 500 was down 34%. That is no small amount, right? Got cut by a third. But that's just a speed bump because if you did nothing and you were invested in the S&P 500, you made your money back by August or September of that year. If you continue to do nothing from January 1st to December 31st of 2020, you made 16%, which is in any context, a terrific year. So we've had a 12-year-long bull run. We had a historic run from March 23rd of 2020 all the way up through 2021. So if we start to look at the volatility through a wider lens, even if we're just looking at 3 years, the vast majority of people have still had positive returns. Now, oftentimes when we log into our accounts, and there's a certain element of behavioral finance and headline grabbing that we're going to be talking about today. But oftentimes when we log into our account, we're seeing year-to-date data. And again, nobody likes what they see right now, right? Everybody's seeing red, everybody's seeing negatives in their account. But if we were to zoom out, the picture looks a whole lot less bleak. So that's going to be, the moral of the story. That's going to be the context that I want to have this conversation in, and that everybody's is on the same page with 2022. But the reality is, this downturn started January 2nd. Virtually everybody is seeing their performance data based off of January 2nd until now. And then there's this other element again of behavioral finance where we treat our we treat our investments like it's a bank account. I am not immune to this either. I do this myself. We feel that if we have $50,000 and it grows to 100,000 over any period of time, and then it drops down to 90, we feel like we lost $10,000. We don't feel like we made 40,000. And if we start to think of our investments in that light, we can start to feel a little bit more confident in what we're seeing. So I have a number of graphs that help support, that theme. But overall, if nothing else has changed and you are already invested appropriately, and no, this does not always feel easy, it's important to stay the course. Because historically speaking, for the past century of market performance, that has always proven to be advantageous. And for some, staying the course, sitting on their hands, doesn't feel like enough. We're going to talk about a couple of things towards the end of the presentation that you could be doing on top of just staying the course. So before I get there, again, I just want to talk about what we're seeing just in a bit of a historical context, because there is, or a lot of folks have forgotten what it felt like to lose money. Because again, in 2020, everybody was losing money for the first 3 months or so of the year, but that was short-lived. Before that, it was December of 2018. That was very short-lived. So that was about 2 months of volatility. There's just been speed bumps along the way pretty much since 2009. So it's very normal and expected to see market volatility. It's part of the risk-return trade-off, right? If there's no risk to investing, then everybody would do it with every last dime that they have, right? So we have to make sure that we're investing appropriately. But what you're seeing, and a lot of the graphs I want to show today, are talking about the S&P 500. Now, a lot of people know it or have heard of it, but the reason we're talking about the S&P 500 is it's 500 large U.S. companies, but it's household names. It's Apple and Amazon and Google, right? But it's generally seen as a gauge or barometer of how the overall market's doing. A lot of times when people say the market, they're talking about the S&P 500. So this shows the past 40 years, almost 42 years. This is up through the end of the third quarter of 2022. You can see the gray bar shows the annual return from January 1st to December 31st. The red dot shows the lowest point, the most that the S&P 500 lost in that year. So in aggregate, the S&P 500 averages a double-digit 14% drop every single year. However, essentially 3 out of 4 years, 75% of the time, 32 of 42 years, the S&P 500 ends up positive for the year. So I already said it, but I'll point it out. In 2020, you're seeing a great example of that, right? The S&P 500 lost 34%, but if you did nothing from January 1st to December 31st, you made 16%. Now, if you're looking at year to date, again, that number looks better. This is just quarterly data, so it's end of the third quarter. We still have that 25% drop, but right now the S&P 500 is down a little bit closer to 15%. So as I mentioned, behavioral finance plays a huge role in our investing. It's so easy to make emotional decisions when it comes to our investments. Again, I'm not immune to it myself. And I've given this presentation a couple times. As you can imagine, this is a popular topic right now. And I used to ask what your best guess for this number is, but the reality is you need more context. So I'll tell you, negative 37% is the decline in the S&P 500 in 2008. Now, a study was done for the following 6 years, where investors were asked, do you think the market is up? So the S&P 500 is positive for the year, down for the year, or flat, right? Flat's just 0%, no gain, no loss. Here were the results of that poll. In 2009, 2/3 of people thought the S&P 500 was down. In 2010, half of people, half of investors thought the S&P 500 was down. In 2011, 70%, essentially three-fourths of folks thought that the S&P 500 was down. It took 3 to 4 years for the vast majority of investors to think that the S&P 500 was increasing in value. To think, if we really break it down, that if they put $1 into the S&P 500, that they had made money. But what actually happened? Well, in 2009, a 26.5% return. In 2010, a 15% return. S&P 500 in 2011, when 3/4 of people thought it was down, it was marginally up. You actually made money, right? 2.1%. And you can see the subsequent return over the following 3 years. Now, what happens if we don't think that we're making money? Well, from an emotional standpoint, we feel like we need to do something, which typically means we feel like we need to sell our investments and head for safety, a flight to safety, right? What happens when we do that? Well, here's the S&P 500 again, from January 3rd, 2000 up through 2019, so into 2020. And it's the impact of being out of the market. Now, if you were just invested in the S&P 500, you did nothing else for those 20 years, you averaged a 6% annual rate of return. Pretty good. That's what most people would expect from their portfolio over a long period of time, 6%. If you miss just the 10 best days, that return drops, it gets cut in more than half to 2.5% each year. If you miss the best 20 days, you're basically flat. There was no point of being invested. You essentially gain nothing. In this case, it's $167 over the course of 20 years. And then you can see 30, 40, 50, 60 days. If you miss the best of them, your return ends up negative over that 20-year period of time. So the kicker is those best days typically fall right after the worst days. And we had one of those days. Now, I don't know if we had one of the days that would end up on this chart. Not quite. Actually, we might have. We might have. I used this chart for a different purpose, but I don't know if you all follow the market daily, but 2-3 weeks ago, we had a day where the S&P 500, NASDAQ, and Dow Jones were all up 5, 6, 7% in one day. But I use this chart because it's something that's very relevant to everybody on this call, coronavirus. Now, March of 2020 had 3 of the worst days in history, 3 of the top 10 for the S&P 500 since 1950, right? A 12, a 9.5, and a 7.6% drop in one day. It also had 2 of the best performing days also in March, right? A 9.4% and a 9.3% return. So if we look at the dates, if we want to be nitpicky, if we after losing 7.6% on March 9th and losing 9.5% on March 12th, if we finally decided, you know what, I've had enough, I need to move my money into cash, we missed 18% or so in return. That came within 2 weeks of those bottom points. So no, I never would imply that it's easy to log in and to see your account and see negatives. But again, if we're invested appropriately, if we know when we need the money, then the best thing to do in a historical context is to stay the course. Now, that's a big if we are invested appropriately. If you don't know if you are, that's a great opportunity to reach out to one of our advisors. But I hope this helps to shed some light on on where we are and where we have been. The last thing that I will say to that point is Warren Buffett has a terrific quote. It's what he attributes amassing his fortune to. Be fearful when others are greedy and be greedy when others are fearful. This is a time when people are fearful, which typically has lent itself to a time to be greedy. Now, that's not right for everybody. And we'll talk about that a little bit later on. Not everybody should be greedy, and we'll talk about why you should or should not. A lot of that has to do with risk tolerance, right? There's no way of saying that we have hit a bottom. But what we do know is that our investments are still at a discount because the markets are still down from their previous highs at the end of last year. What this chart shows is basically just how do we feel about the market, confident or fearful. It's consumer sentiment. And what you see since 1970, consumer sentiment has had 8 low points or troughs. Now, those are represented by the blue dots under the blue dashed line. After those low points, The S&P 500 over the subsequent 12 months has averaged a 25% return. So again, I'm not here to say it'd be a fool's errand if I was, that we have hit a bottom, but what we do know is that we've had a significant decline. And if we were to be a buyer, to be buying investments today, we're getting them at a better price than we were January 1st. So again, a lot of this conversation is about behavioral finance. The reality is we're headline grabbers. Again, I'm do it myself. And if we're seeing headlines that are pessimistic about the market, if we're talking to people at the water cooler who are saying, hey, I'm selling, I'm getting out, it's really tough to go against the crowd. So I think this this video does a great job of illustrating that. So candid camera from, I don't know the date, but it holds true regardless.
As a candidate stuff, these sure going to the transition. Subsequently, one other member of my statement will face the ring. You will see and just a little bit more.
There's another really great one where he is wearing a hat and everybody takes him off. But regardless, the point is, it's really tough to be a contrarian. If we're seeing things in the news, if we're hearing things from friends and family, we feel like that is the, if I'm going against the grain, then I'm doing something wrong. So again, I'm here to say the big if I'm invested appropriately, best thing to do is just not look at it every day, right? Make sure that I'm still evaluating it as time goes on. But ultimately, it has always made the most sense to stay the course and give my investments the opportunity to rebound if I'm in a diversified portfolio. All right, so let's talk just a little bit about contributing to the plan. I love this chart because nobody ever really tells you, hey, you just saved $50 in taxes by contributing to the 401k, right? It's not always that simple. So that's what this chart shows, the benefit of it, the tax advantage. So this is somebody who's making $35,000 a year. They're paid bi-weekly. And just to call out one number, if they were to contribute 10% to the 401k plan, they have $135 going into the 401k. If they didn't do that, if they took that 10% and put it in their bank account, they would actually get $108. The disparity, the $28 or so, is what they would have paid in taxes had they taken that as income. Now, $28 might not seem, so incredible, but the reality is that's just one paycheck. The more money we make, the higher our tax rate, the more we contribute, the larger that disparity grows, the more advantageous it is. Because the reality is that $28 that you would have paid in taxes is being invested for you all the way until you take a distribution. Now, that's not the only way you can contribute to the 401k plan. You can, of course, also contribute Roth. So I don't want to spend a ton of time on this. Just to get to some other things I wanted to discuss. Pre-tax is right. It's exactly how it sounds, right? We just showed it on the last page. You pay your taxes when you take a distribution. Upfront tax advantage. Roth, the exact opposite. You pay your taxes today. The trade-off is you receive tax-free growth. Now, there you can make an argument at any age, any income, any amount in your 401k plan, why you should do one over the other. But the one pretty clear-cut time where one usually makes more sense than the other is when you're younger and newer to the workforce. It would typically make more sense to do Roth because ultimately you want to have both in retirement. It's tax diversification. So if I'm young, the expectation is if everything goes right and I progress in my career, I'll be making more money. And when I'm making more money, I end up in a higher tax bracket. So do Roth today, thinking that it's going to make more sense at 25 than when I'm 35 years old or 45 or 55. Some other things to consider. The very generous company match you receive is always going to be pre-tax, even if you do Roth. So if you're doing Roth, you're being matched pre-tax. You have both amounts of money going into the retirement plan. Something else to mention, you can do both at the same time. So let's say you wanted to do 6%. You can do 3% pre-tax and 3% Roth, or 4 and 2, or 5 and 1, or 1 and 5, any breakdown. You can do them both. Second, am I maxing out my retirement plan? Now, if I'm maxing it out, which the IRS sets limits at $20,500 or $27,000 if I'm over the age of 50, and I'm still looking to contribute more. Let's say I did that all, that $20,500 pre-tax. If I were to switch 100% and did it all Roth, then I will be putting a more valuable dollar into the 401k. So from that last slide, you saw that contributing $20,500, it's more like 17, 18,000 coming out of our take-home pay at the end of the day. If I switched and did Roth, it's more like 23, 24,000, right? Because I'm putting 20,500 in, but I'm also paying taxes on it. So I'm paying more to get a more valuable dollar in today. Where will I live in retirement? Well, many folks are on this call, I'm sure, live in DC, Maryland, and Virginia. I live in Baltimore. I pay state and local taxes. So when if I already knew I was going to retire in Florida or Texas or Wyoming, then I know I'm going to save 8% or so in state and local taxes. For me, it might make sense to do pre-tax, put off paying taxes until that point. A couple other things we kind of talked about. Do I expect my income to increase? If we think it will, then Roth might make more sense today and pre-tax in the future. Impact on my take-home pay, we discussed. If you're only doing 6% and you can't get to doing more, it's more important to get the match as opposed to incorporating both pre-tax and Roth. And then finally, I get this all the time. There's no income limit for making a Roth contribution to your 401k plan. The misconception comes from there being an income limit to make or to open and fund a Roth IRA. IRAs have income limits. 401ks do not. Anybody can do it. All right, switching gears a little bit to talk about investing in the 401k plan. Thank you very much. The IRS did update their limits to 2023. Yes, and please meet with me. So I'll share right now. It is 22,500 if you're under the age of 50, and 30,000 if you're over the age of 50. That's for next calendar year. All right, so how can I create that diversified portfolio that Keith keeps talking about? So there's a couple different ways to do it in your 401k plan. What is proven time and time again for everybody in the country, not just everybody at the academy. The most efficient way to create that diversified portfolio is using a target date fund. Now, a target date fund, if you're not familiar with them, in the Academy 401k plan, it is the T. Rowe Price retirement funds. They are a complete portfolio in itself. Each of them, there's 13 of them. And when I say that, what I mean is they have stocks and bonds and cash, and they're invested in big and small companies, both domestically and internationally. But the most important thing that they do and why they're so valuable is as time goes on and you get closer to actually needing the money, it de-risks your portfolio. A fancy word that really just describes selling off stocks, which we know to be more risky than bonds, and replacing them with bonds and a little bit of cash. So how they generally work is you would choose the 5-year increment closest to when you plan on retiring. Now, not everybody's going to know when that is, but as a placeholder, most people will use age 65. So as an example, if I was born in 1980, I might use the T. Rowe Price Retirement 2045 fund, 65 years after that birth year. Now, if I want to be more aggressive, or I thought I was going to retire at 70 or 75, I can certainly choose a 2050 or 2055 fund. Conversely, if I wanted to be more conservative, or I thought I might retire sooner, I can absolutely choose a 2040 or 2035 fund. Here is how they work. So if all the way to the left, you see somebody young and newer to the workforce. And with T. Rowe Price, they're invested about 99% stock, simply because they have time, right? Time is your best friend as an investor. They know they're going to see a little bit more volatility in their accounts, more ups and downs, but over a long period of time, historically speaking, being invested in stocks has proven to be more beneficial, just having a higher expected return at the very least. So they stay 99% stock for the first 15, 20 years of their career. until that professional investment manager at T. Rowe Price begins the process of de-risking their portfolio, selling off stocks, replacing them with bonds, all the way up to retirement and even through retirement were I to stay invested. Now, I mentioned there's two ways to create that diversified portfolio. If you are a do-it-myself type person, there are 11 stock mutual funds, 4 bond mutual funds, and 1 T. Rowe Price stable value fund. It's essentially cash that you can use to create that portfolio. If you don't know which is right for you, again, a terrific opportunity to reach out to one of the advisors on our team. All right, switching gears a little bit. So as I mentioned, not everybody's going to feel like they're doing everything they can if they're just kind of sitting on their hands through this period of market volatility. Now, sitting on your hands might sound like you're doing something wrong. I hope, through the first 30 minutes of my presentation, I've made that abundantly clear that it's not, right? The big if, we're invested appropriately. This is not a time to make rash or emotional decisions. The most common thing I hear is somebody say, hey, I'm just going to get out until things stabilize. Very arbitrary word. Nobody quite knows what they mean. They just think it's going to be a gut feeling that they're going to get out and get back in at the right time. More often than not, much more often than not, it doesn't work like that. It's kind of a fool's errand to try to time the market. So we prefer to look at the long term and stay invested. But if I had other things available, how can I make the most of this market downturn? Now, I will also preface this by saying this is not going to be right for everybody. Maybe one or two, maybe one of these things makes sense. Maybe 2 or 3. Maybe none of it does. If you have those questions, again, great opportunity to reach out to a CFP on our team. I bring it up today to more so to pique your interest, more so to put a bug in your ear, that these are some things that in the right situation can be advantageous, but they're not for everybody. All right, so first, and I think these fall into this category, kind of advanced planning. First, Roth conversions. So contributing Roth, or if I am, say, older, I've been in the workforce for a while, maybe when Roth first became available to me, I was already in my higher income years and it just didn't make sense. This is a time to consider converting money to Roth. And here's why. So let's just say, for illustrative purposes, I had 1 share of Apple. And Apple, again, for this example, is something I have a lot of conviction in, something I feel really good about for the long term. I know it's taken a hit in 2022, but that's fine. I want to stay invested in it. Well, if I have 1 share of Apple that's worth $100 and I convert it to Roth, so it's going from pre-tax to Roth, I have $100 in taxable income for the year. Now, if that share of Apple first drops to $50 a share, and then I convert it, I have $50 in taxable income, but I still have 1 share of Apple that's Roth, and all the subsequent rebounds will be tax-free. That's why it can prove very advantageous. Also why it can prove very advantageous to contribute Roth at times like this. Second is tax loss harvesting. Does not apply to your 401k plan. Could apply to a brokerage account though. If you have investments in a brokerage account that have lost money in 2022, you may consider, and I'd certainly recommend working with an accountant, you may consider selling some of those investments to take the loss for tax purposes and reinvesting them in a different investment. In that same vein, long-term capital gains. Some folks might have investments that have just, that they've had for 10, 15 years that have performed terrific, but now they've taken a hit and they've never sold them before because they have a huge tax hit. Now might be an opportunity to sell some of it for a lesser tax hit. Number 4, invest cash. Now I have to make this abundantly clear. This is an excess of an emergency fund. Times like this are when emergency funds prove even more valuable, right? Certainly don't expect anybody to lose their job or their spouse or partner, but if that ever happened, you really want to have the emergency fund there to tap into. So this is one that's really not appropriate for everybody, but in the right situation, again, we saw this is a great buying opportunity. And then finally, asset location. I'll talk about that in a moment. So I kind of alluded to this already. So I'll skip over this fairly quickly. But the best times to do a Roth conversion is when when taxes are historically low, which they are right now. We know that if nothing changes with tax law, the Tax Cuts and Jobs Act sunsets in 2026, and tax rates will go up if nothing else changes. My investments are down. We know that to be true for the vast majority of folks. And finally, my income is down. If I was furloughed or my spouse is furloughed, a pay cut, I work on commission, maybe this wasn't a great year. One spouse stops working, that can be relevant towards retirement, all opportunities where I might consider a Roth conversion. So asset location, as I said that, if that didn't make sense, maybe you thought, wait, he probably meant asset allocation. They are two different things. If you have investments in accounts that all have different tax treatment, we call it investing at the household level. So if I wanted to create a diversified portfolio with my whole household assets, and I had Roth, I had pre-tax, and I had a taxable brokerage account, here's how I might go about that. I already mentioned I would want to put all my highest risk, highest expected return investments in my Roth, right? Because if everything goes right over a long period of time, those should outperform the others. And again, it's tax-free growth. Anything that might pay me dividends or coupon payments with bonds, anything that might give me some income every year, I would want to put in my pre-tax investments, because anything that comes out of there is going to be taxed at my ordinary income rate. Anything that I'm just expecting the stock price to grow, the capital gains on, something that I can hold for over a year, I would want to put in a taxable account, because I can benefit from long-term capital gains, which is a lower tax rate than my ordinary income rate, no matter where you fall in your tax bracket. And Morningstar says that type of coordination, and they call it allocation optimization, can create an additional 1% in annualized after-tax returns. Taxes are the big element here. So that is what I wanted to cover today. The last thing I'll add is just one more reminder about beneficiaries. A lot of people don't know this, but your 401k actually supersedes anything you might have in a will. So if you have put on T. Rowe Price's website that you want your account to go to person X, but in your will it's going to person Y, it's going to person X if something were to happen to you. It supersedes what's in the will, makes it even all that more important to make sure that your end-of-life documents are coordinated with beneficiaries on these accounts. So if you have any questions, please reach out to our team, right? That's what we're here for. You can reach us by phone at 443-578-3211 or by email at 401kadvisor@onedigital.com. This presentation was recorded, so if you have any colleagues who weren't able to make it, or if you missed part of it or just wanted to rewatch, I'm sure it will be sent out. So I'm hanging on. If there's any questions, if there aren't, and you're dropping off, thank you so much for giving me the time this afternoon. Happy holidays. Oh, thank you so much. Oh, thank you. I'm glad to hear it's helpful. All right. Well, I see most people have dropped off. So if there are no other questions, I will go ahead and end the presentation. Again, thank you so much for the time, and I hope you have a great rest of your day.